A couple of things. We've just been through basically the quarterly results in the US. So there's been a lot of information coming through from that, and we're now just getting stuck into the full year reporting season in Australia. So a lot of information coming through. I think by and large, the way the market is looking at this is it's essentially giving companies a leave pass for 2020. So to a certain extent, the results from this year are largely irrelevant, and to some extent dividends as well. But the market's trying to work out what the next 12 months and beyond looks like. And again, that's very difficult for a lot of these businesses. A lot of them aren't providing guidance. But I think a significant focus is what is the liquidity profile of these businesses. So long as they have the ability to manage their debt positions, then markets will typically take a decent sort of relief from that, knowing that, thinking that eventually at some stage you'll get this recovery out the other side.
So is that why the market is sort of just bubbling around that same spot, and it almost seems like it's just the market's on hold at the moment, really? Like it just doesn't go, goes up, down, just stays around that 6,000 sort of point. Is that sort of the medium outlook? Is this just everyone's not too sure, so it doesn't have any confidence to go either way?
Yeah, look, you're spot on, Ben. I think, that's it. So it's been essentially consolidating, just in this really tight pattern between about sort of, 6,000 and sort of 6,200 for, 2 months or so. And I think, that everyone's just trying to work out if there's going to be a vaccine and if life gets back to normal. And I guess you can imagine it if a vaccine does happen, and if, or whatever, some therapy, and people decide life gets back to normal, then markets break up from here and move forward. But if that's not going to be the case, you would expect that markets sort of take that lead down again. So there are, my understanding is there's 8 different vaccines where we will have phase 3 clinical trials coming through over the next 3 to 6 months. And so I would say generally the market's of the view that, at least one of those should have some level of efficacy that enables, life to sort of get back to normal. So I think that's why the market's kind of hanging in there.
And it's always a difficult question, I suppose, practically thinking about those clients that do have cash and are, installing it into the market in line with sort of our recommendations about when to actually slide that next instalment in. And we slide it in while we're in this holding pattern. Do we wait and see that the vaccine potential is not as great as we thought it was, or do we potentially miss out on that upswing? It's the number one question, but it's the one we don't have the answer for, I suppose.
That's it. And it's this same dynamic that we've talked about for some time, that markets aren't cheap in an absolute sense. They're somewhat expensive, particularly given the uncertain economic outlook. But when you compare the price of the market relative to these ultra low interest rates, the market is potentially cheap. And so you have these two really strong forces sort of, and the other thing is government stimulus that's obviously supporting things as well. So it's so difficult, right, in terms of that asset allocation question, because from a long-term perspective, we know that these defensive assets, cash, government bonds, that sort of stuff, prospective returns are, after inflation, potentially negative. So that pushes you toward, equities and these other asset classes. But we also know that, there's a lot of economic uncertainty that could impact those higher returning asset classes as well.
What are the what are the stock in the Sato portfolio that at the moment you'd continue to press an argument for being undervalued?
Yeah, so I think these more defensive sort of businesses that we've always had really good weightings in the portfolios, where some of them the price moves haven't been extreme. So Sonic Healthcare, for instance, is an obvious defensive example that everyone has a lot of. And so that's great, but at the beginning of the year, Sonic was $28, and now because they're quite busy doing COVID tests, it's now $34. So it's a defensive business, but it's quite expensive at the moment, in my opinion. But then if you look at something like Ramsay Healthcare, which we've been sort of adding into portfolios, that was sort of $75, even $80 pre-COVID. It's now sort of $65. So that's Sonic is pathology and radiology, and Ramsay is private hospitals. So that's interesting to me. It's nice and defensive, and the price isn't sort of extreme. Brambles is the other one, that we've put in portfolios as well, again at the beginning. So Brambles provides those CHEP pellets that, all of the consumable goods are transported around on. So again, very defensive sort of business. Brambles was $12.50 at the beginning of the year, and it's sort of $11 at the moment. So they're sort of a couple of examples. The other one, which is more a cyclical sort of thing, the other newer stock that we sort of have put in portfolios is Macquarie. That is a bit riskier in that, to a certain extent, it's going to be somewhat reliant on economic conditions. So if you have an economic recovery, you would expect that Macquarie will benefit from that. But if things really take a dive from here, then, Macquarie, you would think, would be hurt. But if people don't have a lot of bank exposure in their portfolios, we're sort of happy to have a little bit of Macquarie in there to sort of give that upside if you do have that recovery come through.
Probably on the bank thing, where do they sort of sit at the moment? We were talking point a while ago, and then they probably kicked back a little bit, and then, much like the market, have sort of been hovering around the same point. Where do they sort of find themselves, or where do you feel they sit at the moment?
Yeah, so CBA has reported this morning. I haven't even had a chance to have a good look at it. I just saw a headline. The dividend was actually better than expected, but I haven't drilled down to that. Obviously, these are sort of at the pointy end in terms of exposure to the economic climate. And CBA has been relatively very strong, but the other three majors have been really weak. And so the market's obviously taking, a dim view of the outlook there. The question is, how much of that is priced in? That's a more difficult, we know that the outlook for the banks is going to be tough. The question is how much of it is priced in with its share prices down where they are. Based on the consensus dividend forecast for next financial year, so remember that the dividends got slashed dramatically this year, and they're forecasting dividends to increase next year, but nothing like where the dividends were last year. Based on what those dividend forecasts are for next year, and that obviously can move around a lot, but basically they're trading on grossed up yields of, call it sort of 9% on those forecasts at the moment. So you sort of look at that, and when term deposits are at, call it, you're getting less than 1%, versus 9% grossed up in a bank. Clearly, the bank is significantly riskier, but you're getting compensated for that risk as well.
Yep.
So the answer has been, I think having some banks in the portfolio is sensible, but you just don't want to have too much because of that risk.
And so it's probably not a position that we're looking to expand on. I think people get caught up in that, projected dividend yield, but there's usually a reason. There's usually some risk associated with that. You don't just get, compensated for nothing. So it's
exactly right. There's a lot of assumptions baked into that dividend. So you just can't have too much exposure to that. To that thematic.
Hamish, for the banks, is the biggest concern like potential loan defaults? Given Yeah,
absolutely. There's that. Plus, the other things are, post the Royal Commission, just life is generally tougher for the banks. And the other factor is a low interest rate environment makes it harder for the banks to generate a reasonable interest margin. So their returns essentially are lower in a low interest rate environment. So, it's a combination of all of those factors. But again, so obviously the outlook is challenged, but again, how much of it is sort of priced into the share prices.
There's certainly a role for the banks to play in the economic recovery from the government's point of view, though, isn't there, in supporting individuals through this period of time.
It's been quite incredible, right? Just to see go back 12 months or so ago, the banks were just being absolutely destroyed by everybody, and today they're doing a pretty incredible role. I'm just looking to CBA's opened up 2% on the back of its result. So that is a new high since COVID. So that's positive. ANZ's opened up sort of 1.5% on the back of it. Westpac will be up as well. So so they must initially they must like the look of the result.
We're going to have to fly, Hamish. We're a little bit late for our next meeting, but thanks again for the update.